Good afternoon, everyone. On behalf of Etf Is Alumni Relations team and the Alumni Association, I'd like to welcome you all to the Balancing Act, Financial Management in Uncertain Times. It is wonderful to see so many alumni and friends joining us today. My name is Lisa Young, and I am the Senior Associate Director for Etf Is Alumni Relations Office, and I'm serving as the host for this session. We are excited to offer this online session. Over the past few months, our office has been working hard to transfer our programming from in-person to online. I'm happy to report that we have alumni joining us from all around the province, across Canada, as well as from south of the border. I'd like to begin by acknowledging that the land I am speaking to you today on in Vancouver is where I have the privilege to live, work, and play on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. Just before I introduce our speaker, I want to highlight a few points that will make today's session run smoothly. During the session, everyone but the speaker will be muted. If you want to ask questions or comment, you can either use the chat box or you can virtually raise your hand, and then we will acknowledge you to unmute your mic and speak. You can find the raise your hand function by clicking on the participants box at the bottom of your screen. Within that box, you'll see a little blue hand. If you're having technical difficulties or need assistance, please use the chat box located on the bottom of your screen to send a message to Tech Help, and we will try to assist. Just a reminder that this session is being recorded for public viewing after the event. We will be launching polls for you to take part in. If you've logged in via the browser rather than the app, it may be that you are unable to see the poll. Unfortunately, this is a limitation of Zoom. However, Brandon will discuss some of the results. I would now like to introduce today's speaker, Brandon Chapman. Brandon is an SFU BD alumnus of 2016 who now works as a certified financial planner with Freedom 55 Financial. Brandon is passionate about financial literacy, technology, and the success of the communities he is a part of. He operates a Vancouver-based wealth management practice dedicated to helping business owners, professionals, and families navigate effectively and efficiently through life. Brandon specializes in retirement, tax, and estate planning, and integrating the intricacies of business and family financial planning. In addition, when not working, Brandon volunteers as a board member and treasurer of the SFU Alumni Association. Welcome, Brandon, and with that, over to you.
Thanks for that introduction, Lisa. Great to be here today, and fantastic to see so many alumni joining, many of which I know, and others hopefully will become friends in the near future. I hope everyone's family has kept safe and remained vigilant through COVID-19. I know it's certainly taken us by storm. We're going to start off with a quick poll to get an idea of the career stage of everyone in the group today. So please just take a moment and vote in the poll, and that will give us a better idea of who is in the room today, so that I can try to tailor some of the content more towards our group. Seems like we got lots of fresh alumni as well as some more experienced alumni today, with a few in the mid-range. Fantastic. Okay, so the Balancing Act. Why did we call it the Balancing Act? Well, the purpose of the session today really is to talk a bit about how to handle financial planning in terms of a crisis. I don't think any of us expected COVID-19 to hit as hard as it has across the world. So I first just wanted to share a little bit of a story from my life. In 2001, my father suffered a heart attack. At that time, I was 11, my little brother was 8. I come from a middle-class family, and we were very dependent on his income. This crisis had serious ramifications on my family, where we had to change our lifestyle overnight. Today, COVID-19 has put a lot of families in similar situations where us Canadians are no longer earning an income. And that's really why we're hosting this session today. Many businesses and individuals are needing to think outside the box to make ends meet and to survive and thrive in the future. Even if you haven't been impacted right now, it likely has heightened your awareness of the fact that you should be thinking about the future and the potential what ifs that could happen in your own life. So as Lisa mentioned, my name is Brandon. I'm the treasurer for the Alumni Association and a certified financial planner. And today I'm hoping to share some insights that could be of benefit to you and your family. As an agenda, we're going to walk through the 3 rules of financial planning, managing debt, investing in this market. We'll briefly discuss government grant programs, as well as wills, power of attorney. At the end of the formal session, we will have a Q&A session in which you can ask questions directly to the group, but please do feel free to comment throughout the session. We'll get to those questions as we can. Now, if anyone has read any books on financial planning, there's 3 rules of thumb that you'll come across quite often. And I'm going to review those with you because I think if you don't take anything from the session today, I would definitely suggest that you take away these 3 rules of thumb. First one is to work with an advisor you trust. It's really impossible to know everything, and so it's really important to leverage the expertise of professionals. If you're just getting started, you may be able to learn the basics of financial planning online, but as your situation becomes more complex, there is value in having support and having a second opinion from someone who has your best interest at heart. My family did not have an advisor when I was young, and those unfortunately led to some mistakes being made that cost my family. We've made up for them over the years, but it's been quite a challenge. The second rule of thumb is to pay yourself first. Somewhere between 10 and 30% is what most professional advisors will recommend. And you'll think, okay, well, how do I do that? Typically, you want to be setting money aside in an Rrsp or pension program, tax-free savings account, or other planning tools and strategies unique to your situation. It's easiest to build this habit when you're starting in your career because good habits scale just as bad habits will scale. If you don't set up this habit early on in your career when you're making 50 or 60,000, then even when you're making 100, there's a good chance you'll continue to spend most of your money and it won't allow you to build up the reserves for an emergency fund, for buying a home, raising a family. And the third rule of thumb that I like to make sure everyone that I speak to knows about is you should always have that emergency fund set aside. An emergency fund is typically around 3 to 6 months of your expenses. And the reason why this range is if you lost your job, that's the average amount of time it usually takes to find another job. If your business wasn't earning for a period of time, this would give you a buffer so you don't need to rely on high interest debt like credit cards. If you were sick or injured, typically you may have a long-term disability program, which would kick in a few months after you became disabled. And if you had that buffer, it would avoid you needing to rely on high interest debt. 3 months is usually okay for folks that have a fairly secure job because they would likely be covered by employment insurance or expect some severance if they were to be let go. 6 months is more the range I like to see with professionals who are self-employed or for business owners, because they may not be entitled to the same government support that those covered under EI would. Managing debt. So debt is a scary word for some people because they perhaps have borrowed the wrong way or they have borrowed too much. And coming from Vancouver, where real estate prices are extremely high and you pretty much have to borrow a lot of money in order to get a home, I felt it would be very important for us to discuss the difference between good and bad debt. Bad debt is high interest debt that is not helping you build your wealth. Examples could be credit card debt, personal lines of credit, or gambling debt. Good debt may be a mortgage or a tax-effective business loan, typically with lower interest rates. You should aim to never carry bad debt if possible, as the interest payments can be crippling. You should look to increase your debt when it makes sense for your situation, such as buying a home, starting a business, or buying stocks when they're at depressed prices, depending on your level of expertise and experience. Now, if you own a home, it is important that you have a home equity line of credit set up if you don't need the money, because that could also act as an emergency fund since your available HELOC credit could serve this purpose. If you've lost your job or are facing financial difficulties, you may be able to defer your mortgage but be aware that your interest continues to accrue during that deferral period. We'll talk next a little bit about investing in this market. What I like to draw folks' attention to is the fear and greed mentality when it comes to financial markets. Back in January, investor sentiment was quite positive because the markets were doing very well and we were seeing all-time highs on a regular basis. However, once COVID set in and the market dropped, people started to get scared and people weren't as greedy. Typically, we see markets drop when that happens. So we're going to jump into another poll here, because I'm curious to know what you did with your investments over the last few months. Did you invest more? Did you sell some? Was there no change, or do you not invest? I see a good mix. There's some folks that managed to invest more. Some sold some of their investments. No change. Interesting. Okay, but very few sold your investments. So I have to applaud those of you that didn't sell when markets were down. Unfortunately, in say 2008, 2009, there was a lot of people that sold their investments, and many of them are feeling the pain today. So the question you may have is, what do I do now? Have I missed the boat? The short answer to that is no, you haven't missed the boat. The world will continue to evolve and the economy will grow. We don't have the ability to drop interest rates as we have, so that is something to keep in mind. But when we look at central banks around the world, they all are finding unique ways to keep the economy moving. If we look at, say, Japan or the Eurozone. If you don't think this is the case, you may as well just buy some guns and build a bunker underneath your house. I think there's a show called Doomsday Preppers, which should help. But at the end of the day, if the money is for the long term, you should continue to invest and consider world events that impact markets negatively as buying opportunities to build your wealth. This slide is showing major catastrophes over the last 50 years. What if you had invested when these time headlines came out and left your investments for 10 years? Many people were scared during the 2008 financial crisis and sold their investments. But if you look at the extraordinary gains missed, $100,000 invested in the S&P 500 on March 9th would have been worth $400,000 10 years later. Now, of course, we don't drive by looking in the rearview mirror, but it is interesting to look at some of the past previous economic events and how those have impacted financial markets and the events following. So my key insights here with regards to investments are: continue to invest during good and bad times on a consistent basis. When the markets are down, deploy more capital if possible. You should consider reviewing your situation with an advisor. Even though you may think you know everything, almost everyone doesn't. And I admit, even I don't know everything, but I do my best to try to share what I do know to help people make the best decisions possible. Next up, I'm going to briefly review some of the government benefits that have been announced over the last few months. I do have a colleague and fellow SFU alumnus on the call, and he'll be able to speak to more of these specifically at the end of our session, because he has done a lot more research on these than I have. These particular slides I'm going to share are from Get Granted, which is a grant consulting company that does good work for companies in the Lower Mainland. So first off, we've got the EI and the CERB, employment insurance, and the $2,000 a month from Bill Morneau. EI would be your first lifeline if you were laid off, typically because you'll get more depending on your income than the CERB. The CERB is only $2,000 a month, and it is considered taxable income. So for those of you that have been receiving it, make sure that you are setting aside a percentage of that to pay for taxes. EI also is taxable, and that's a benefit you'll receive depending on if you've paid into it and if you've qualified prior to getting laid off. A piece that I wanted to draw your attention to is if you were furloughed from your employer, please be sure to speak to an HR professional about your rights, as it does seem some companies are using this as a way to not pay severance and also not pay for their employees' wage. But I'm sure it's not your company, but do make sure you know your rights. Okay, so what programs are available for your business? The first program that all business owners should be aware of is the $40,000 loan available from the BDC. Some of this is actually non-repayable, depending if you meet certain requirements, such as paying back the $30,000 portion by the end of 2021. There's also the 75% wage subsidy program, although you do have to see at least a 30% reduction in revenue to qualify for this program, both of which have certainly helped keep some businesses afloat that otherwise would have had to shut down due to no income or very little income over the last few months. There's a number of different funding options that you should consider as a business owner, and it is difficult to understand all of what is available to you and submitting the proper paperwork. I don't know about you, but whenever I go to a government website, I tend to get a little bit lost. And so it helps to have somebody who specifically knows how all these programs work and help you complete the paperwork. So don't try to do it all yourself. Try to bring on a consultant if you can, as some of them are pretty reasonably priced, as they may just take a cut of whatever the government ends up giving you. There are also COVID cash benefits, and there's some timing along with that. So CERB is $500 a week, as mentioned, or $2,000 a month. The CEWS or wage subsidy program, 75%. So far it's 12 weeks. We'll see if it gets extended. These programs have been retroactive, so if you haven't submitted but you have faced difficulties, you may still be able to apply. Personally, I wasn't able to qualify for these programs, but my wife, she finished law school in April, and she then didn't qualify for her articling positions, as many of them were pulling back their offers. So she qualified for the educational savings program, where she basically received $1,250 for 4 months, which really helped her, as she didn't have any income based on that. I won't get too deep into this, as it didn't look like we had a ton of business owners register for today, but if you want to learn more about these, we will speak more to it in the Q&A if you ask us questions. But the key insights to take away from these government programs are: try not to get lost in grant applications. Bring on a consultant to support if you get lost. The next piece we're going to talk about are wills and power of attorney. Now, I don't know if any of you have any side hustles. Maybe you produce cat videos online and you have millions of followers. If you do, it's fantastic. But what happens if you pass away tomorrow? Who's going to keep your followers entertained? Who has the password to your YouTube account? People think about a will as something that deals with your home and your assets, but digital assets is something that you should also be considering as you worry about your estate plan. If you passed away tomorrow, what would happen to your assets? And it's a slightly morbid thing to think about, but the way I position it to clients is, it's better you have a slightly awkward conversation now with your family than a very awkward conversation afterwards if you haven't made these arrangements. So the immediate needs you'll want to consider are: have you provided for final expenses such as probate fees, mortgage costs, etc., to make sure your family is going to be okay? Also consider your long-term needs. So are your important documents in a place that your family can find them? People assume that the government gets their money if they pass away. It's not necessarily the case. With poor planning, the government will get more of your money through probate fees and potential additional taxes if you structure your assets in a more efficient way. But typically, your spouse would get your assets distributed through the estate. There would be provisions for children if you have them. If you don't have a spouse or children, then descendants or your parents could potentially get your assets. That's if you have no will. If you do have a will, you can determine whether certain charities may get your assets. And I've been helping a lot of clients plan for that, because many of them care about nonprofits or institutions such as SFU, and they do want to create endowments or support initiatives that they care about. Many people do build that into their estate plan, and it's something that you should plan for early if you do intend on doing that, as there are some tax benefits. Fun fact now, wills can be done virtually in BC. So anyone that doesn't have a will yet and you've been delaying getting it because you didn't want to go down to the notary's office or your lawyer's office, you can now do it virtually, and they can sign virtually to accept the will. Okay, so to summarize the formal portion of the session, I just want to say that I recently came back from my dad's for Father's Day, He's still alive and kicking, two heart attacks later. So just like my dad, if you're going through tough times right now, you're going to get through them as well. So I hope that this session has allowed you to think a bit more about some of the various aspects of financial planning so that you can survive through COVID and thrive into the future. Now, the last three insights: work with professionals you trust, continue to invest during good and bad times, leverage government programs, and make sure your will is done in a place that your family knows it's at. And I'll pass it back over to Lisa to round things up for the Q&A.
Brandon, thank you so much for sharing all that with us. I think it is great for us to be reminded about how important it is to find and work with a financial planner that you trust. Pay yourself first between 10 to 30% based on your situation, and to keep an emergency fund of 3 to 6 months. So definitely there's a number of things that I've got to work on, so thank you. To me, it sounds as though you are suggesting folks to begin with those 3 tenets of financial planning, and then you can build on that foundation with your debt management strategies, investing in the market to build your wealth, amongst other things. So now it's time to open up the floor to questions. If you have a question, please type them in the chat box or raise your hand and we will unmute your mic. While we wait for folks to type in their questions, I do have a question to ask Brandon. Brandon, can you tell me, what are the differences between Tfsas and Rrsps?
Yeah, that's a great question, Lisa. They're both good programs, but a common misnomer is people think, oh, I have a tax-free savings account. And then I always ask them, well, what are you invested in? And they say, well, I have a tax-free savings account. And they don't know that you can actually choose what you invest in your TFSA. Both the TFSA and RRSP offer tax benefits. The RRSP will give you a tax deduction when you put money in, but you'll also be taxed when you take money out of the RRSP. So it's more of a tax deferral, versus the tax-free savings account offers a lot more flexibility. You will not get a tax deduction when you put money into the tax-free savings account, but you also don't have to pay tax when it comes out. So I think RRSP, think about retirement. Tax-free savings account, think midterm savings, perhaps buying a home, perhaps saving for your retirement. But you also have the flexibility to take money out when you like.
So Brandon, I would say, what do you recommend to people? A little bit of both, or how does one decide?
Well, everyone's situation is different, Lisa. So, typically what I see is if you've just started working, you may be more incentivized to put more into the tax-free savings account if you intend on earning more down the road. Doesn't mean you don't contribute to the RRSP, but typically I'll see younger investors put more in the TFSA and a little bit into the RRSP. And as they get more experienced with investing and in their careers and they're earning more, then they'll put more in the RRSP and perhaps a little bit less in the TFSA, mainly because they get more of a tax benefit the higher income they make.
Okay, thank you. We do have a question that came in. It's Ken, and I'm sorry, this is an acronym, Ken can CECRA be used for rent on a commercial property instead of residential rent?
I haven't actually experienced this, but I'll see Enoch has responded in the chat. And if Enoch wants to speak to it, he's welcome to as well.
Okay. Let's see.
We'll put that one on pause, and then if Enoch wants to join afterwards to speak, then he can do that. I see there's another question I think that came in though.
Okay, hang on, let me just see. You know what, I do have another question here, and then I'll take a look at what's in the chat. Should I save while I still have debt?
Yeah, it's a great question, because Canadians love paying off their mortgage, and they use it as a point of pride to say, I've paid off my mortgage by age 45. And I've heard many people say that. It is a feat to pay off your mortgage early, but the challenge is if your mortgage rate is only 2.5% and the stock market's doing 7 or 8%, if you would have just been paying off your mortgage for the last 10 or 20 years, you may have actually lost out to some growth. 5% difference between your mortgage rate and the growth in the stock market. Now, we can't ever promise the stock market's going to do 7 or 8% on an annual basis, but we can try to plan for that. If you're not comfortable with the stock market, you're probably better off paying off your mortgage than putting money into a GIC though. So everyone's situation is different. Some people may choose to pay down their mortgage versus invest, but typically it's a combination of both.
I see. Okay, thank you. I can definitely see the value in having a financial planner because I think it's just needing help to kind of weigh things out too is important. So thank you for that. Next question. When should I get my will done and do I need to use a lawyer?
Yeah, so the trigger events that I typically say are when you definitely want a will are if you have a child, if you buy a home, or if you have significant assets that don't have a beneficiary. So a TFSA and an RRSP, you typically will have a beneficiary, so you can list your spouse, your family. Rather, if you have a non-registered account, or if you have some collectible coins, or if you have some family heirlooms or a home, you typically would want to have a will to determine where that's going to go. However, a power of attorney, I would say, is more important even at an early age, because if something happens from a health perspective where you can no longer make decisions on your own, you want to have someone who's able to make those decisions for you. So I'd say everyone should have a power of attorney set up, but the will, you could probably delay a little bit until you have some assets that you want to protect or get to the right place.
Okay.
And you said, is a lawyer needed? You can use a lawyer or a notary. So some people will use draft info online and then speak to a lawyer or a notary. Like most professionals, just try to work with somebody you trust, who you know is looking out for your best interest, and they should guide you through the process.
Okay. I definitely have had tried those kind of online ones where you kind of have a bit of a template. So would you say just kind of like drafting that out first, putting some thought into it, and then going in and talking to someone would be the way to
Totally.
go?
Don't just download something online and write it out and think you're good. Like I agree. That's basically like doing some research so that when you speak to a professional, you can use their time effectively and say, I've actually already thought about it and here's kind of what I want to happen. And then they'll give you some thoughts. As a financial planner, I'll typically suggest how you might want to structure assets from a tax perspective, in collaboration with, say, an accountant, to make sure that more of your assets will go to family versus Justin Trudeau. I'm sure he could use it right now, though. We're spending a lot right now. Versus, the lawyer, the same thing, right? If you come in and have an idea of what you want to do, they'll tell you legally how you should structure it. But that's typically where they'll come in and help.
Okay, thank you. So we do have another question. Is it better to invest in mutual funds or segregated funds?
Yeah, so Christine, thanks for the question. These are asking about product types. So mutual funds are typically used for, mutual funds or ETFs are a basket of stocks and bonds bundled into a portfolio in order to reduce risk. There's pros and cons to every different product, and it really depends on your own situation. I would say mutual funds and ETFs are typically better for younger investors that are putting money into their Tfsas and Rrsps. Segregated funds are better for perhaps business owners or for individuals who have more assets outside of registered accounts, because you can actually add a beneficiary to a segregated fund, which could allow you to save money on probate fees and some complexity at death.
Okay. Sorry, Brian, can you explain what an ETF is?
Oh, for sure, Lisa. So an ETF is an exchange traded fund. Typically, they are set up to mimic an index. So you may hear of Vanguard or Wealthsimple, and they offer low cost options for people to invest in the market. So typically for younger investors, I suggest these might be a good option to get started. And then as they build up more wealth and they can enlist the support of an advisor, then they may have access to other investment options.
Oh, okay. Thank you. Next question is now still a feasible time to apply for a credit card to build your credit score and credit history?
Yeah, so I got my first credit card when I was 18 years old, which I think was the earliest I was able to get one. And I think it might even be earlier than you're supposed to. And that's just because my mother worked at the bank. And the reason was I wanted to build up that credit so that I had a better chance of buying a home. And now I've been able to get my credit up to around 800 because I've had lines of accounts open. The key is pay off all your debts. if you owe a credit card company, or if you owe a Kudo or a telephone provider money, just pay it off. It's not worth the risk in the future of your credit getting hit and you not being able to be approved for credit. Another interesting fact is my wife is a twin, and her twin name is Christine Joy Escobedo. My wife's name is Christine Dawn Escobedo. So their credit was actually jumbled up. So when we started applying for credit, it was actually a real pain. So everybody should know what their credit score is by going to, say, a Mogo or one of these online sites, Equifax, to determine what your credit is, because there might be something on there you don't know. So take a look and just check and see. And then if you need help figuring out how to get it better, I can let you know, because we've gone through that process already.
Yeah, you know, actually I've been able to check my credit score even just when I'm doing my online banking. So I bank with RBC. So there's like a little section where I can do that, and it's really simple and really helpful. So yeah.
Awesome.
Yeah. So next question is, do you have any advice for first-time home buyers looking to buy during these times?
Yeah, this has come up a lot with clients recently because the economic situation is very unique. Now, first off, find a realtor you trust who is not just trying to sell you anything. They should care a lot about what your goals are and what your budget is. Your budget should be determined based on your financial planner's recommendation and ideally a mortgage broker. The broker will field and find you the best rates. The planner will tell you what you can justify in your monthly expenses. But my overall advice is figure out what your budget is. Start searching in geographic areas that make sense for you. In today's market, we are seeing some competitive parts of the market, and we are seeing places where the market is actually favoring the buyers. So it's important that your realtor has a good understanding of which markets are doing well and which aren't, and align that with your own goals and objectives. Avoid getting into multiple offers with no subjects. I've heard of people putting in an offer with no subjects because they thought it would increase the likelihood of them getting the place, but that is a lot of risk, because if you put down a down payment on a home, or a deposit, I should say, and you then can't get financing, you're going to lose out on that $50,000 or $60,000, which it would be a big hit, and it will very much delay you in getting a home in the future. Another key point with regards to buying a home right now, even though there is the Homebuyers plan of up to $35,000 from your RRSP towards the down payment, doesn't mean that you necessarily should do it. That program, it can be used in some scenarios, but do realize that you're going to lose out on a large chunk of RRSP money growing for you tax-free over the next 10 or 15 years as you pay that back. Hopefully that helps.
Okay, thank you. Next question is, what about identity theft? Is there a way to protect myself against identity theft other than monitoring my credit score?
Yeah, so with Equifax, you can actually have them put a fraud blocker or alignment, essentially letting Equifax know that you think there may be a person that has access to your information, and then they will actually require that you approve additional layers of credit in the future. It makes it harder for you to get certain levels of credit, but it will protect you from fraudulent activity. At the end of the day, I think it comes down to making sure your personal information is safe. Try not to send personal information through email. And if you are entering in personal information on the internet, make sure you understand where that information is going to go and who's going to have access to it. I typically say if you can, over the phone is probably still the safest way to share that type of information, or in person. So as much as I like the digital world, there is some value to pen and paper in some way, shape, or form.
Yeah, absolutely. I think now more than ever, I think people are getting very smart at how to capture your information with phone calls and emails and things like that. So I think it's really important to be extra cautious and very careful too. So thank you. Next question is, should I buy stocks on my own? YouTube makes it look pretty easy.
Yeah, I follow financial markets quite regularly, and there's a few YouTube people that I follow. But I would caution you against investing large sums of money on your own. The reason is you're essentially competing against Wall Street, and you're competing against big companies that have a large budget to do research on stocks and bonds. I'm not saying don't invest in stocks on your own, just start small. So whether you're using a Wealthsimple trade account or a Quest trade account, it's worth trying and to buy and sell securities, but start small and see how it goes and go from there. If you work a full-time job and you're doing this off the side of your desk for fun, there's a high chance you're going to lose money. And the vast majority of people that try to invest on their own do lose money. Most of the YouTubers that are advertising buying and selling stocks online, they make more of their money from YouTube than they do trading stocks. I think there's a guy named Portnoy who's been really saying everyone should buy stocks right now online, and he's almost a parody. But the sad thing is many people are following what he's saying, and some are doing well and some aren't, especially when it comes to puts and options where things get even more complicated. So like most things in life, take it slow, do your research, talk to some professionals before you bet the farm.
Okay, thank you. Next question is, what are the best ways to invest?
I'm not sure the best way to answer this question, but there are a few different ways you can invest. So you can buy stocks on your own through a brokerage, maybe through your bank. They'll charge you some level of a trading fee. You can invest with an advisor who will purchase ETFs, mutual funds, or segregated funds on your behalf. They'll typically charge you for that. You can buy ETFs on your own as well. Same thing through a Quest trade account. I typically say if you're just starting off and you don't have an advisor who's willing to give you the time of day, then yeah, starting off with buying your own ETFs and buying a broad-based index, that will reduce your risk exposure and at least get you some exposure to global markets. But yeah, typically when you're just starting off, it would be start opening up an account with either your bank, which I typically don't suggest, or through a Quest trade account, a Wealthsimple account. And then down the road, as you grow your assets, try to work with an advisor that will support you, because the fact of the matter is life gets busy and you won't be able to keep tabs on everything as best as you thought you were before. Yeah, hopefully that helps.
Yeah, thank you, Brandon. So we're getting close to the end of our time. I do have one last question. I have someone who says they're interested to learn more about the government programs. Where can they get more information? And do you think that there will be more programs offered?
Yeah, so Enoch shared a couple links here. I also, there's a lady named Stephanie Sang at Granted, who also is quite an expert when it comes to these grant programs. So feel free to add me on LinkedIn, and I'm happy to make a connection if your business needs some support on that end. But I expect that there may be more government incentives down the road if there is a second wave of COVID. It appears as though many of these programs were structured to finish around this time or over the summer, but the economy recovery is going to be likely much longer. So the best place to get that information is directly from the CRA's website as Justin Trudeau announces new programs. But if you are able to get on a mail list for a company that specifically does grants, that will help you stay up to date so that you don't necessarily need to continue to follow that instead of focusing on your business.
Okay, thank you. Sorry, I think we have one more time for one more question, if you're okay, Brandon.
Yeah.
From Claudia Wang, can we set up power of attorney online? And would you be able to provide some websites for online will later?
Yeah, please send me a note on LinkedIn, and I can send you a couple. There are a couple that some of my clients have used. Willful's one. They seem to be okay for basic situations, but if your situation becomes more complex, then it may make sense to speak to a human. I think that tends to be the case for most things, whether it's investing or wills. You can do the basics on your own, but then as things get more complex, then talk to a human.
Okay. Brandon, thank you. And I just want to say thank you to everyone who submitted questions. Brandon, thank you so much for sharing your expertise with us today. It's really been very illuminating, very helpful to me. Thank you to everyone for their insightful and interesting questions. Before we wrap up, I Want to share a couple of initiatives that we've been working on. We've been working hard to build out our career support section for our alumni and have recently added 25 career resources online. So if you're looking for some career advice, whether it be resume writing, improving your online presence, or wondering how to network while social distancing, check out our curated resources on the SFU alumni webpage under benefits. And the link for this is being posted in the chat box now. And in addition, I want to share with you that our next online session is 360-degree career management, taking control of your future, and that's taking place on July 9th at noon. Helen Dewar, who will be our guest speaker, she is a certified career practitioner who has worked as an educator, instructional designer, facilitator, and career coach for over 20 years. She works with professionals on a specific career planning journey to improve their re-employment skills and define their goals towards finding satisfying work. Helen designed and developed and facilitated the award-winning Minerva Helping Women Work programs attended by over 500 professionals in BC. If you have questions about your career or you're looking for work, this is a session you won't want to miss. You can sign up on the SFU alumni webpage and it is listed under online events. So we'd like to wrap up. Thank you again, Brandon, to all of you attending and also the behind the scenes teams in alumni relations and the ceremonies and events department that made this session possible. To all the attendees, we'll be sending you a follow-up email with a link to a post-event survey. We ask you to please complete it. This survey is one of the ways that for us to find out from you what type of programming you're interested in. So please share your ideas and input. It is really important to us. And with that, our session has come to an end. I wish you all a lovely afternoon, everyone. Stay safe and well.